Let's talk about translating the financial landscape so that we can all make that happen. So showcasing and explaining funding options from angel to major funding rounds available to founders, advising what businesses need to consider and how to go about choosing that work for their business. Joining me on stage, ladies, Flor Kasai, a partner at Inflection Private Equity. As partner, Flor is responsible for sourcing, evaluating, and leading investment opportunities with a particular focus on financial and business services. Erica Young is a director at Anthemis, an industrial designer by education. Erica has extensive experience designing, developing, and manufacturing products in China for international markets. She has immersed herself in the startup community as a co-founder within both consumer and enterprise technology companies, ranging from robotics to clean energy, so a real wide breadth there. Also joining us is Sonia Power, co-CEO at Boost & Co. Sonia has spent 15 years in private equity. Boost & Co. aim to understand innovation and entrepreneurship and create financing solutions to help SMEs develop. They don't have a fixed lending model, and every one of their loans is individually designed to fit each SME's needs. And also, finally, Leslie Gregory, chairman of Memory Crystal, joins us on stage as one of the few female chairmen at a UK law firm. Leslie Gregory has led Memory Crystal through several strong financial years, worked to expand the firm's international offering, and encourage an internal culture focused on diversity and core values, all while maintaining her top-rated corporate practice. Ladies, welcome to you all. Pleasure to have you with us today. So let's start off by asking about just what funding options are available to your business. Flor, if I can start with you. So Inflection are one of the UK's leading independent mid-market private equity houses. You invest in high-growth entrepreneurial businesses. So just explain what that means and how you're different to other equity houses.
Yeah, sure. So we invest out of a family of funds, which makes us quite flexible in the way we invest. We have an enterprise fund, a majority fund, and a minority fund. And what this means is that we can invest in businesses from 20 million enterprise value up to $1 billion, putting to work somewhere between 10 million of equity up to 200 million, as I said, in majority or minority situations. And you asked me in what way we're different to other private equity firms. I think we're different because, firstly, is the flexibility point that I just made, which it makes us very unusual in that you as a company could come to us, and regardless of your size, we will have a solution that we can tailor to you because of this ability to do minority, majority, and a quite wide range of size investments. I think the second area that makes us different is what we do as a partner to your business, which is we're very focused on growth, and we try to bring something to the party that is not just money. And what does that mean? Well, we've built a business that basically allows you to plug your business into our platform, and hopefully by the toolkit that we bring to you, allow you to grow at a faster rate than you would do if you were by yourself. And this is by our network of international offices. We can help you expand internationally. Via our origination team, we can help you find M&A targets, and then with additional funding, do those additional M&A. With our digital team, help you do digital transformation in your business. And also with our talent team, help you develop the further talent in your business as it grows. So those are the main areas. I think that the third area we were different, and it's one that I'm particularly proud of, is because I think that as investors, we are not just looking for the return to Inflection, but we are, what I believe, responsible investors. So we were, for example, the first private equity firm to raise a foundation. So out of the last funds, we've raised the Inflection Foundation, where a proportion of the profits that we generate go to the foundation, and this, once the funds reach maturity, will give between 5 and 10 million pounds to organizations that are focused on young people, increasing opportunities for young people. So we have a much broader view to the impact that we have in society than just growth.
Okay, Wonderful, thank you. So, Erica, Anthemis is what's known as an early stage investor, and you invest in what are known as financial wellness businesses. Just explain what this means.
Sure. We are focused, we're mission-driven or purpose-driven as an organization, and we're focused on reinventing financial services, kind of at the core. And that's why we have a number of different activities in-house, similar to what you described, an institute, an ecosystem development team, et cetera, as our value-add services. But we have about, I would say, 5 funds or managed vehicles. It doesn't matter what the legal jargon is around it in this context, but we can invest from before you have a business, so before you are incorporated, all the way through to what we would call in venture investment terms Series.B. So that's what is kind of determined an early stage investor. And when I talk about financial wellness, we actually have 2 vehicles that focus particularly on this space. And the reason we do this is we're very thesis driven as an organization. So what that means is that we're looking for things we believe should exist in the world and seeing if they exist. And we believe that there is the relationship between your physical health, your financial health, and your mental health are inextricably linked. And so therefore we're seeking businesses that are really trying to identify that overlap and solving those types of problems in society.
Okay, Erica, thank you. So, Sonia, tell us more about Boost & Co. You provide debt solutions, so you don't have a fixed lending model. You practice what's called precision lending. It doesn't require the business to give up control or autonomy. It sounds too good to be true. What's the catch?
So just to respond, nothing should feel too good to be true in finance. If you've got that feeling, there's something not quite right, you haven't understood it, it's not good. So our model works that we provide debt to help you grow your business. The options are that you can go to a bank and you can raise debt from the banks, but the banks tend to be risk averse these days, or you need to be much bigger or profitable or years of audited financial accounts. Or you can go and raise equity, and at certain times, equity is the right solution. But for lots of businesses, debt is a great option to raise funding where you can use that to scale up your business, you can keep control, you continue to make all the decisions, and you don't suffer much dilution. And it works on the premise that we look for businesses that have already achieved a level of success to date. And we use that to say, well, if you've achieved this so far, then we trust you and we back you to make decisions that are in the best interests of your business to continue making future growth. And so you are, in effect, exchanging some of your cash flows to service the debt, to repay the debt. And in exchange for that, you get to hold on to a much larger stake of equity. It's not right for everybody. And sometimes businesses are too early, and sometimes actually businesses have gone past that stage and need a different type of funding. But for a large chunk of businesses, it's a really great option that they should consider.
Thank you. Leslie, you're a lawyer, so you can keep your microphones working, I think, so you'll be fine. Thank you. So you can't give anybody money, but you specialise in capital markets, and your work includes flotations, secondary capital raisings. What does that actually mean? How can you help our audience?
I think Sam should be answering this one. So yes, just sort of briefly, we work, I'm a corporate lawyer and chairman of a law firm that is very focused on helping entrepreneurs. So we work through all stages of growth, and I like to give very independent, objective advice and basically steer our clients to the right funding solution. At the early stage, clearly the public markets don't work, but we do want to highlight, in a lot of cases I think it's overlooked how good the public markets can be for companies at a particular stage of growth. Maybe an option to taking a private equity investment is actually to consider the capital market. So it means really going public on a company growth market like AIM, which I think people should think as not as an exit necessarily, but as a stepping stone to growth. So it is just a way of accessing further capital and not having one particular investor controller. You have a range of investors who will generally leave you alone as long as you're making your targets and projections. So there's a downside to that. Clearly, if you don't promise what you've said and deliver, then you're very much in the public eye. But it's just an alternative way of accessing growth, and think of it as a stepping stone, not an exit, because you can buy and build using the capital markets. Private equity investors often stay in for some of the ride during that, and then potentially get attractive as a takeover target. Ultimately, there's an exit on the public market. So it's just a different route to consider.
There'll be lots of people in the audience who have very different types of businesses at various different stages. I'd like to get the benefit of your wisdom as to how do they consider what funding option might work best for them? Floor to you first.
Yeah, so I think there's several things to consider. One is what's the next stage for your business? So, for example, as Leslie's saying, if you're planning, for example, to invest a lot and your profits are going to dip, that might be better done in a private environment, so either with debt or with equity, where the plan is very clear, as opposed to having to manage a large pool of investors and explain quarter after quarter why your profits are dipping, which sometimes it's more difficult. So if we stick with that scenario, then the question is, well, do I go with debt or with equity? And again, the bit you need to analyze is what's the purpose of what you're trying to achieve. If you're looking for a small amount of cash, for example, and just someone to plug that gap, then maybe debt is a better option. If you're looking for a partner that's going to be almost supporting you in that journey and helping you achieve that, then a combination of debt and private equity may be the right answer. Then the other thing that you need to think about is control. Are you ready to give up control or not? Because that will take you into different routes. You have private equity funds, so within Inflection, as I said, we could do minority stakes or majority stakes. And then the other thing I think to consider is what you want that partner to help you with. So if there's a specific thing, I want to expand internationally, I want to crack a new business line, well, look for a partner that has done that, look for evidence, speak to the CEOs of businesses within that private equity fund that have done that journey and ask them, what was your experience? Better still, speak with CEOs who have worked before and are no longer with that private equity firm, because they have no axe to grind, and they'll tell you how it is.
Is that quite easy to do, to just sort of approach people who you don't know, other CEOs?
Yeah, I think what you need to do is just be bold and ask the private equity firm you're dealing with, look, that sounds great, your case study sounds really good. I'd like to have the chance to speak with the CEO or the CFO of that portfolio company or ex-portfolio company, and everyone is ready to do it. We are ready to do it. We do it all the time, in fact.
I would say similarly, in the very early stages, we often will have founders who will come out and say, well, I've talked to a number of your portfolio companies, wanted to get a sense, because if you are taking a board seat in that case, because it is the very early stage.
So do your homework, don't be scared.
Yeah, absolutely. Ask the tough questions, because this is somebody who you are going to be intimately involved with for a period of time. So.
Do you have any other specific advice?
I would say for early stage, it's much more about, I would say, the sweet spot is before product market fit. So basically before you've proven your model, and you have to heavily invest in that ambiguity of what actually is the appropriate go-to-market and what allows this business to scale, then venture capital is really a great option. But I think, like you said, it's about, is that money smart? Do they have the relevant expertise? Do they have the right network? How proactive can they be to support you as you're growing your business? And looking at the previous successes that they've had in their portfolio. Not just looking for exits, right? But more about, do they understand your business? Have they invested in B2B enterprises before? Have they invested in consumer-facing, high growth? And so that they know what the challenges you're going to face along the way and are able to provide relevant expertise.
Thank you, Sonia.
Yeah. So I agree with all of that. We would look at things just a little bit differently. So we say, obviously, work out what you want to achieve in the next 2 or 3 years. Work out how much money you need to be able to achieve that. Build in some headroom. Things aren't going to go to plan. And then have a look at the risks that are attached to your strategy. How do you look at those risks, and how will your investors look at those risks? Where you can categorize what you're going to do in the future as being more of the same. So stuff that you've done in the past, but now you're going to do it faster or in more geographies or with a bigger team, that investors will see as lower risk. And that's far more easier to fund with debt. The new stuff, so I'm going to try this crazy new idea, or I'm going to have this new product, that's better suited to equity. So try and look at how you're going to achieve your goals, split them between what's perceived as lower risk, what's perceived as higher risk, and then try and match the funding needs behind that. That will give you the optimal structure and allow you to hold on to as much equity as you want to, but also partner up with the right people. And then I think just meet lots and lots and lots of people. It's really important that not only can you work with them, but you like them. And so when things get tough and you've got to argue some stuff out, that you know that you're going to be able to do it in an enjoyable, constructive way. And so taking references is really important.
Yeah, I would also say, I see a lot of female-led growth businesses, and who I advise not necessarily just on legal matters, but on types of funding and the best funding. And quite a lot of calls I also get are about crowdfunding. Why can't we do crowdfunding? It sounds great, and we get all these different shareholders, and we'll promote our brand. And frankly, it does work for some businesses. We've done quite a lot of areas in retail bonds where the company is consumer-facing, it has cash flow, and actually it can borrow from its supporters and database, like sports clubs, and it's worked very well. But a lot of businesses think they can just go and, they've seen crowdfunding, and I think people need to be aware that there's a lot of disadvantages to that route. It may sound great, and you may get a very high valuation, and you've got lots of small shareholders, and then you come to do your next funding round, and you've got nobody there who's necessarily going to support you, and you may end up doing what's called a financial jargon, a down round, having to raise money at a lower valuation and have a lot of very upset shareholders. So I don't think crowdfunding has a place, and it's good to democratize funding, but take a lot of advice before rushing into that route.
You will all thank you. You will all have seen a lot of CEOs and founders come through your doors. What would you say are, from an investor's perspective, the key ingredients that they need to have to make their business a success? Flor.
I think the first thing, if you're planning to bring in external funding, is the mindset, because especially if you're used to running the business by yourself, now you're bringing someone else, either in a minority or majority position. You're going to have someone now at a board level contributing, hopefully, to the business, but you're bringing someone on board. And so, as I said, the first thing is be ready to bring someone on board, because otherwise that will create friction. And the best thing that you can, you'll get the best out of that partnership if you're ready to embrace it. And then the other area, I think, where financial investors, especially for the stage in which we invest in, which are companies that are already profitable, making 2-3 million EBITDA and more, is a focus on the finance function. So making sure that the finance function is ready to receive an external investor, because there will be more pressure in terms of getting numbers out. There will be more oversight from a sort of governance perspective on the board, on the corporate structure of the business. So it may not be absolutely ready, but you may need to be ready to change that if you're bringing someone on board.
Okay, thank you. Erica.
At our stage, it's very much about, do they have a locus of control, right? Do they feel they have agency to deliver on what they've set out to do? Mindset, certainly, growth mindset is certainly very critical, particularly if you're bringing complementary skill sets together where they're both very passionate and both very determined. How you're always going to have gaps in that. So how do they have the sense of onboarding other people's advice and having a sense of coachability? I think also, of course, very principled, right? This is a very early stage business, and they're going to have to make an incredible number of decisions with a high level of ambiguity. We're often looking at, particularly when you have a co-founder or a 3-person founding team, what is the dynamic between those individuals, and what do you have a sense of alignment among them? Because one of the biggest challenges you see in early stage is misalignment of founders. And that is a foundational element that if there's a crack in that foundation, it's all going to topple. So those are the types of things we're absolutely looking for at that early stage. And are they the best person in the world to be starting this business? Because probably this business doesn't exist in the world, or there are very few of them, certainly. And does this person have the right combination of disposition, skill set, network, et cetera, in order to see that through, either as an individual or as a collective?
Thank you. Sonia.
Yeah, just to echo that. So by the time they come to us, we are looking for a team. So not an individual. They've probably done as much as they can do as an individual, as a CEO or an entrepreneur. They need to have a team around them. They need to be 2, 3, 4 people who collectively have demonstrated that they can work together. They might fight, but that they can work together and achieve things. And then they need to set out their vision of what they're going to achieve in the next 2 or 3 years' time. We know nothing's going to go exactly to plan. We know there are going to be risks. And so you want people that can be honest about that, who can articulate that, this is what I'm going to do, this is what I'm going to try and achieve, but these are the risks. And when these things happen, this is how I'm going to address it. Whether that's exactly how things pan out or not doesn't really matter. Nobody can predict. But you need to be able to articulate that you can think ahead. That's what investors want to know. You can think ahead, you can plan ahead. Then you are more likely to be able to face those challenges. So it's that combination of, yes, a team, yes, you have a vision, but you're also thinking 3 steps ahead that convinces us that here's a great team to back.
Thank you. Leslie.
And when I see various businesses, I think, first of all, the passion of the founder is very important. As you said, the team around you, not necessarily in the business, but outside the business. Have an advisory board, have people who mentor you, who've done it before. Ideally, they would have been early stage investors, but not necessarily. And then obviously on the legal side, just to be a little bit boring for a minute, but make sure that if your IP is properly protected, make sure that you have sat down with your co-founders and actually legally enshrined your vision and how it works between you, because that helps, as you said, to make sure that you've thought about the issues before you go and see investors. So just take a step back and make sure that your house is ready for outside investment.
Governance is not boring, it's critical.
No.
It's absolutely critical.
Indeed.
Ladies, thank you very much for your expertise and the benefit of your wisdom. So lots of take-homes there, really. When you're thinking you're at that stage, when you're looking for funding, be ready to bring someone on board. Make sure that you are the best person in that world, or can at least convince investors that you are, to start this business. And make sure that you're able to articulate that you can think and plan ahead. And also make sure, as Leslie said, your business is legally enshrined. Thank you all very much for your expertise. Flor, Erica, Sonia and Leslie, thank you.